Well, good evening, investors. We hope you have all recovered from your Thanksgiving feast. We're happy to have you with us tonight for our November 2022 roundtable. My name is Mark Robertson. I am joined here by my dear colleague to the north of me, Ken Kubula. Say hello, Ken.
Hi, everybody. Glad to be here. This is always a fun evening.
And we also have Cy Lynch from Atlanta, Georgia. Both Cy and Ken are renowned for their national presentations at the national convention and basically have served as educators for several years. Good evening, Cy.
Good evening, Mark and Ken and Kevin and everybody.
And we're joined for the first time by special guest night, Kevin Galogli from the DC Metro and I guess / Maryland chapters of NEIC Better Investing. I've known Kevin for many years and welcome him to the contributing team tonight. Thanks, Kevin, and welcome.
Thank you. Thank you, Mark. Glad to be here, and happy birthday.
Well, thank you. And and for those that haven't heard the news, the United States men's team did prevail over Iran this afternoon, and they are moving on and will be playing on Saturday in the World Cup. So that's kind of our date stamp for tonight. And I'm
going to really impress you, Mark. I even know who they're playing on Saturday.
Whoa.
Whoa. They're playing the Netherlands, okay? So I just exhausted my wealth of football knowledge now, okay?
Well, yeah, there's a lot of people out there getting their 4-year dose, 4-year between doses. But I have to tell you, I've been watching soccer every weekend for the last several months. And it happens to be 6-year-olds and 8-year-olds out there on the field. So it's a little different type of soccer.
I went through that also, Mark, for 8 or 9 years. That was long enough to watch that kind of soccer, I'll tell you.
All right. Well, enough of the tangential stuff. Here's our standard disclaimer. No investment recommendation is intended. This is about education, and it really is about sharing an idea. And the four of us tonight will be sharing an idea and then looking it through a process or a method to analyze an investment opportunity made famous by the modern investment club movement via the vehicle of investment clubs. And the methods that we'll be talking about tonight are, as we understand them, as they are championed by the National Association of Investors, NAIC, also known as Better Investing. And at Manifest Investing, we basically follow very much the same protocol at looking at companies. A couple minor tweaks, but it's basically the same philosophy, the same type of lessons and techniques that have been used by the modern investment club movement for the last 8 decades. So they will be our opinions. Please do your own homework before making a decision about any opportunity. If we hold a particular stock, we try to remember to let you know about that. If you'd like to have a friend or a family member be aware of these monthly webcasts, we've been doing them for 12 and a half years now. You can send an email for an email reminder to nkabula1@comcast.net, and you'll be added to the reminder list. Natalie will not inundate you with emails. She'll simply make you aware when we're holding either a roundtable webcast or an educational opportunity. If you'd like a copy of the slides or if you have follow-up questions, my email address is markr@manifestinvesting.com. Ken's is kkabula1@comcast.net. And with that, I think we can keep rolling. Anything you'd like to add, Ken?
No, we're ready to go, Mark.
All right. Just real quickly, our standing agenda is to basically welcome you if you're here for the first time. We keep it fairly informal. We're going to go through our series of ideas, but welcome. We do keep track of how we do, and we do it with some gratitude, as you're going to see. We keep track of the choices that we make and have done so for about 12 years. We do take care of the portfolio. It's a little bit different portfolio in that it's a very large tracking portfolio, but we do apply some of the same selling decision criteria and take a look at hot seat stocks. We don't have much to go tonight, so we'll probably whisk through that. And there you see the 4 presentations: Boot, Western Alliance, Apple, and First Foundation. We do have a poll after the 4 stock presentations. Even if you're here for the very first time, you are welcome to vote. We have methods and techniques in place to make sure that you only vote once, but we do want your vote to count. And that's the last thing I'm going to say that's even slightly political. We do leave time for, we try to leave time for questions and answers at the end. Anything else you want to add at this point?
No, let's keep it chugging forward here, Mark.
All right, here's just a quick reminder. This is what we have been doing. The mission is to bring an idea and subject it to the same type of analysis. We do welcome core companies and non-core, more speculative opportunities, but we do try to limit them to a fairly modest segment of the portfolio. We keep track of the performance of the entire portfolio, shooting for a long-term relative return that is beating the market by 5 percentage points. That's 500 basis points. And we actually are meeting that right now. We would like to see the majority of our selections beat the market also from the time of selection. Here's a look at our results over the last several years. Like we said, we've been doing this over 12 years. The rate of return since inception is 14.6. The Wilshire 5000 over that same time frame, using mirroring investments, matching investments, would check in at 9.7. The difference between those two numbers is 4.9%, basically 5%. So we are basically beating the market by that 4.9%. That is what is graphed on the page. Relative return is this 4.9% that you see. So again, I think in the spirit of our recent Thanksgiving holiday, we have to have some thanks and gratitude that this process has served us so well. It's one of the most intriguing demonstrations of community-based investing that I'm familiar with anywhere in the investing world. So that's pretty cool, and I thank all of you for your participation. Your thoughts, Ken?
Well, I think it also demonstrates, Mark, that as you learn as a group of investors, you become a little bit better than you were before. And, our slide up to that red dotted line there took about 7 years, maybe a little bit more than 7 years. But then since that point, we've managed to stay pretty close, up and down a percent or two from that red dotted line. Again, folks, this is a 14.6 annualized return. We're graphing the relative return, which is showing how much it's beating the market. So the takeaway from this is that the portfolio itself is growing by 14.5, 15% a year over year over year for a long period of time.
Okay. Here specifically is what has fueled that graphic. What you're looking at here are the top 20 positions by the value or the percent of total assets. Starting with our number 1 position in Microsoft, ranging down to number 20 at T. Rowe Price. And the legend up at the top gives you the key as to how many times a particular stock has been chosen. So in the case of Microsoft, if you look up here, you'll find Microsoft in the 5 times camp. Anytime that has been selected by a knight, a damsel, a guest knight, guest damsel, or the audience, we invest $1,000 into that company. So in the case of Microsoft, $5,000 has been invested in Microsoft, and it is now $61,306, which is a pretty good run. And again, I just hearken back to a few months ago when we shared the reality that the gains in Microsoft alone offset every single loss over the last 12 years. I would, if you weren't here for that, or if you're curious about that, I would encourage you to go back and basically check that out. And it's just almost incomprehensible to me. So some of the stuff that jumps off this page to all of us, Costco is a single time selection at 11,000. Amazon is a 2-time selection at 12,800. And what jumps off the page at you guys?
Well, I just like the idea, Mark, that so many of our top 20 are still good, solid buys. They have par values that are still quite attractive, and you know it's not a bad thing to be looking at some of those stocks that you already own with quite attractive pars. And if you have the cash to put into some of the things that you already own, I know it's a little bit more boring than taking a ride on a stock you've never heard of before, but I think in the long run it's probably more lucrative. It's amazing to me how many of the stocks in that final column are in double digits there, which suggests that they might give us a pretty decent return.
And Cy is responsible for Cognizant, the EPAM. What else is up there? The
MKSI.
MKS Instruments, yep. Maximus is somewhat. Cy is definitely a champion of information technology for sure.
I think Five Below. I did not bring Five Below. That was Nick who brought it. But I think I picked Five Below back when none of the stores were open.
Oh yeah, I remember that vividly. I remember thinking you were crazy. And you were crazy right. All right, and of course Regeneron has been pretty good to us through the entire COVID process too. How many times is Regeneron up here? I'm missing it here. Oh, it's actually been selected 7 times, so it's doubled in value. Okay, well, those are the companies responsible. You can actually go to this link at the bottom if you want to see all the positions. I think there's some 80 open positions right now.
It's kind of humorous when we kind of look at it just a doubling and we say to ourselves, well, that's not very much, you know.
Very true. All right, at Manifest Investing, we basically take 2,700 stock selection guides and answer the question, what's the average projected return? That's what my par is. Basically, the average or median projected return for all the companies in the database. That stands right now at about 11.6. So as we are out there shopping for stocks, we want to shoot for one with a little bit of safety, margin of safety, looking for a minimum of 16.6, but then not getting too greedy and not going too high. Not swinging for too much of a home run. We want to stay in that type of range. And that just seems to be a pretty effective way, again, based on 8 decades of doing this, to do that sort of thing. Here's the portfolio characteristics. We do want the average growth rate of the companies in the portfolio to be somewhere in that 12 to 13% range, so we're a little bit strong. The projected annual return is actually a little bit under where we would like to be. We'd like to approach that 16.6 number. So that's a little bit light, but we do have excellent quality companies in the portfolio. And the other ones are all fairly normal characteristics. The hot seat basically is to take the companies that are in the tracking portfolio and ask, well, who has the lowest return forecast? And these are the 5 lowest return forecasts in the portfolio. Lockheed Martin has actually gone up 37% since it was added to the portfolio not that long ago. And in so doing, the return forecast has actually been driven down to a little bit less than 4. Now, I don't know, this came up the other day, but I'm still finding that many money market rates are down fairly close to 0. There are some that are in the 1 to 2% range and some in the 3% range. If you've got a decent core holding with a high quality rating, we basically we're not in a hurry to sell a company that's trading higher than money market rates is basically what I'm saying. So I don't think we're in any hurry to shed any of these quite yet.
And I'm not calling any of these non-core, although Gilead probably comes as close to non-core as any of them, doesn't it?
Sure, Gilead is definitely a special case. I mean, the short story is that they're constantly putting themselves out of business by curing things rather than making customers dependent on medicine. So that's really the problem that they face. It's a nice problem to have. They actually cure people. So
I would just qualify one thing from what you said, Mark. In this particular tracking portfolio, I agree 100% with what you said. as far as core holdings and money market, and not in a rush to sell. And in particular, in these particular holdings, if you look, with the exception of Aflac, they're not very significant shares of the portfolio anyway. But if this were a managed portfolio of anywhere between 10 and 25 stocks, wherever an individual or a club's portfolio would fall, if you were close to 2% below, or below the sweet spot between 1.5 and 2, I'd be looking perhaps to sell some of the lower holdings and boost that up.
Yeah, and I agree with
Yeah,
that.
I'll double down on what Cy is saying also, Mark. Two of the clubs that I'm involved in had substantial holdings in First Financial. That's been a favorite bank of mine and the clubs around here for half dozen years or so. And First Financial has been discovered by a lot of people as an excellent bank. That doesn't change any of its values except for par. And if a lot of people discover and think it's wonderful, then that drives the par down. We did in two of the clubs that I'm involved with, because our total par was underneath where we'd like it to be, we sold off a significant portion of our First Financial shares and put them in a couple of banks that had a little bit more potential. I shouldn't say a little bit more potential, I should say a lot more potential than we estimated First Financial had. So I'm right in Cy's camp 100%. This whole way of managing a portfolio was new to me 8 or 9 years ago, but boy, has it worked out well.
Yeah, and I would agree. If Lockheed Martin was 6 or 8% of the portfolio, like Cy said, dealing with 10 to 20 stocks, it would be a completely different consideration. So yeah, absolutely. And Boston Beer keeps floating around on this list also.
Mark, we're getting a lot of questions about Ardelix, and I see Ardelix is coming up on the next slide here. Can you kind of bring people up to date on what's been happening with the company since last we spoke?
Yes, I can. What you're looking at the screen right now is just the companies in which we flag for a scratching of the head. Any company that is lagging the stock market by more than 25 or 30% basically makes this list and just nudges us to say, are we okay with this company? In the case of Generac at the top here, I don't think there's anything fundamentally wrong with Generac. They're going through a lawsuit and they had trouble with a supplier. I just think it's kind of a ride the storm out. In fact, I will probably be adding to Generac. And of course, the audience will join me, so we'll be putting a couple thousand here in the next month or so into Generac. I mean, PayPal's another one. I don't think there's anything fundamentally wrong with the company. MKS, another good company. First Foundation, that's actually going to be added to, that we think so highly of it here tonight. Ardelix is a special situation brought to us by Hugh McManus. In some cases, as much as you can see here, that's 7 years ago. Okay, Ardelix makes a solution for dialysis patients that basically brings phosphorus into better control. The comparison that has been made is between the current medications, taking like 9 to 15 horse pills a day to have a similar result to what you can take with 3 BB-sized pills using the Ardelix solution. It's a company that Hugh's been watching for years. They got within inches of approval and then were denied a little over a year ago. The FDA basically said no. The company has appealed it. Within the last month, an advisory committee actually stunningly recommended that they reopen the phase 3 situation at Ardelix. That will happen within the next 30 days, according to the playbook. And many people believe that Ardelix will be approved for this kidney dialysis treatment within the next calendar year. Now, that may or may not happen. This is a sheer speculation. I have actually added to the Ardelix position a few times over the last several months, and all of the case, the story is still intact. Basically, you had a gatekeeper that went away. was not replaced by the FDA for several months, by appointment. And again, this advisory committee has really kind of stunned everybody. And the stock price has gone from where it was languishing down less than $1. It actually floated around up above $2 here fairly recently. And Hugh McManus still believes that with approval, this could be anywhere from a $6 to $12 stock virtually instantaneously if this actually comes to pass. So that's kind of the rundown on it. Again, it's a work in progress. It is a sheer speculation. They can still fail. But some of us have been watching it fairly closely and kind of having some fun with a little speculation with our non-core speculative portfolio on the side.
I think, Mark, the fact that you put two of these on the same slide, showing us the way this looked in November and then showing us the way this looked in October, also shows how fast this market can be moving in many instances.
Mm-hmm.
I see all the stocks that appeared in October, Advanced Micro, Intel, MarineMax, and I see them disappearing from the list in November. So it's giving me pause for one of the rules that we talked about during the bull market, which was to cut our losses pretty quickly. In this bear market, I think the behavior has to be maybe quite a bit different than it was in the bull market. And I'm really glad that we didn't cut Advanced Micro and Intel and MarineMax and all those out of the portfolio. Only to see them in less than 30 days recover, back to a place where the losses aren't nearly as significant as they were.
Yeah, and I mean, Generac has gone on to lose 20%. The point to be made, maybe it's something we need to reinforce with a little bit of a case study. I mean, we did have the stock Iconic Brands, which went from $10 and basically lost 20% the first month that we had it. We walked away from it because we weren't comfortable with that. And then it proceeded to lose 80%, and then 80% of what was left, basically all the way down to zero. And that's what we're looking to avoid. A company like Generac and PayPal, I don't think they're vulnerable to the same type of thing. So again, this is kind of like screening results. I regard this trigger as just one piece of information to basically nudge a selling consideration of these type of companies. So take that for what it's worth. We also do pay some attention to the attitude of the rhinos, the institutional investors. And sometimes they get a little bit frothy. The relative strength index, when it goes up above 70, is overbought. Those are shown down at the bottom. Maybe one more nail in the coffin for Gilead, treating this as an opportunity to walk away with, again, $2,800 on a $2,000 investment made not that long ago. And so, again, it's a successful walk away. There aren't any companies right now that show up as oversold in the portfolio. All right. So with that, unless there's any other comments on that stuff.
No, we're staying pretty good here, Mark.
Well, let's go ahead and turn it over to our friend Kevin from the DC Regional Chapter, and a colleague of mine that dates back to our Chicago days, and spent a considerable amount of time with Kevin out in the Washington, D.C. area. I welcome him to the session tonight and would invite him to explain his digging into BI initiative a little bit also. Welcome,
Very good.
Kevin.
Thank you. Yes, I'm Kevin Galogli. I am director in the DC Regional Chapter, but I actually live in the Maryland chapter. And sort of what you guys have been doing here for the roundtable, we started doing a joint program with the Maryland chapter and the DC Regional Chapter, where on the first Monday of the month, we look at the latest issue of Better Investing, hence digging into the BI, and we look at the two featured stocks, the undervalued feature and the stock to study, and then two other stocks, but they have to be found by using a BI tool. So in other words, you can use a heat map, it can be a first cut, it can be from here, from the round table, the 5 and 5, wherever you found it, as long as it's through the BI source, that would certainly be fine. And so we just celebrated 2 years last month. We will be having our December meeting next Monday. It's free and open to the public. You can find us on the DC Regional Chapter under local events. You can also find us on YouTube under Digging Into BI. And you can find us on our Facebook page, which is the DC Regional Chapter. And there are links in all of those to our registration that you can come. You don't have to be a BI member to do it. We do 2 of our stocks in core SSG to help out beginners, and 2 in plus. And so, yeah, we've had probably 26 different people from either of the 2 chapters, not all directors, all participating. We don't have the numbers that you have in terms of attendance, but we're working on it. Anyway, enough of the commercial. But yeah, I decided I'd look at Boot Barn Holding. And if we go to the next slide, I'll tell you. And for those people that don't know, Portillo's, which is a fine Illinois business, what they have is since Mark and I are both native Illinoisans, but we don't live there anymore, is that if you go to Portillo's and you get on their freaking buyer program, when you get 20 visits, you get a free visit to your cardiologist. And if you get 50 visits, you actually get a free stint put in by Edward Life Sciences. So please consider that when you go to Portillo's, a fine place. Love their shakes, love their sausages, love their dogs, and you don't put ketchup on a hot dog, in case you're wondering.
And now I'm going to get a letter in the morning from the Portillo's investor relations team. All right.
Anyway, so what got me started on this was when during the bull session, before you did your small company stuff, you and Ken were talking about Hoover's emerging companies. And I think, Mark, you were really, really proud of the fact that you were able to find an old issue for only like $5 or $10. And I said, well, let me see if I can find it in my public library. And sure enough, the Enoch Pratt, which is a Baltimore City library, had the 2020. And I got it, and I, of course, immediately sent it off to you and some of my club members. And I said, let me look at all the ones that are on there, 600 companies, and find out which ones one of my 2 clubs or the Digging Into BI have taken a look at over the last couple of years. And that's what the division came up with. And rather than reading all this, let's just go to the next slide. It may be easier. These are the ones I zeroed in on. So I was sort of looking at it with both the core score and seeing, I sort of created sort of a sort of peg ratio just to sort of get a feel for things. And, you know, I like Evercore investment. It's boutique investment banking, but I don't think they're going to be there. I think you can wait on that one for a while. CoStar, but I think too expensive. Ollie's, I just got burned a little bit. I need to jump back in. I really wanted to do East West Bank Corporation, but Ken, Mark told me I can't do a bank unless I got your approval. It's unfair for anyone to do a bank without the express written approval of Ken Kavula, even though I own it and have done very, very well with it. I was thinking of Fleet Corp, but you guys have.
By the way, Kevin, I'm in a club that owns East West Bank Car also. So,
well, I presented it to my to the model club. They didn't take it. I got it. It doubled for me, and we didn't buy it until after the price went up. That's been known to happen a few times. So I wanted to look at Fleet Corp, but I saw that you guys had done that. So I decided I'd look at Boot Barn, even though it has a par that's really, really high. And I think that's one of the things that made you take it off of your small company list, because it was maybe just a little bit too frisky on that end. But I'm going to walk through it and just sort of show you what I got. So let's go to the next slide. So here's some of the basics. I won't read this to you, but it's in the S&P 600. It's only been publicly traded since 2014. It doesn't have 10 years of data, so value line, there isn't a value line on the value line, and it's not covered, it's only covered quantitatively by CFRA and Morningstar, so it's got limited coverage. But what it does is it sells Western and work-related footwear in retail stores, and they have a little bit of a different twist on it, and we'll talk about that when we go to the next slide. So here's some background on it. About 49% of it is boots. And then they have apparel and hats. But what they do talk about is that they really have a lot of, a lot of their boots are workwear. I initially thought that they were going to just be a bunch of cowboy boots. But because of the fact that they had workwear, they were considered essential business and were able to stay open during the pandemic. So if you look at your SSG, you're not going to see that retail dip that so many companies had. And they are really trying to stay as a store preferred purchase rather than trying to be able to move to e-commerce. So they're going against the grain on that. Next slide. So here's some growth on it. These were things that I found rather interesting. New customers generate about half their revenue growth. The median age since the IPO is dropping of their customers, and they're really getting a healthy growth in the Hispanic consumer market. All of those seem like real positives to me. So yeah, and the other thing I want to say is about this, their investors stuff is it's very clear and straightforward. Sometimes you go to them and they really sort of are muddled with their numbers, and I didn't find that at all with Boot Barn. They were very straightforward. Let's do our next one. Here's their CEO, and Ken, you have your CEO girlfriend over at AMD. I may be starting to get a man crush on this guy because, again, what I've been reading about him, he, again, very straightforward, where he's coming from. I like these Investor Business Daily articles when they feature a CEO. You get a really good feel for them. So he's the one who brought him in from, helped bring him to the IPO, and they've really grown from when he added at 230 million to 1.5 billion. They grew the stores, and down at the bottom, they want to add new stores. They're building exclusive brands, and they have a different spin on their e-commerce, and they really want to power their same stores. So take a look at that article, and you'll see more about it. Next slide. Total addressable market. Sometimes these things are a little bit on the fudgy side. They always sort of make them look pretty good, but they're still, even at 1.5 billion, even if you think that the 40 billion that's now their total addressable market is a fudge and a little high, there's still, the bottom line is there's still a lot of room to grow in this company. So it's not, again, it's not just cowboy boots. There's work boots are a strong component of this. So those are things for people that are never, their jobs are never going to go overseas. So very, very good component for it. Let's do our next slide. Here's their store growth. Again, very clear. They think they're going to get unit growth around 13%, same store sales in the mid single digits. And this multi-trails in retails is basically sort of a new way of doing sort of the marketing. Those aren't competitors in the lower right, like Lululemon and Ulta, but they all have the same approach in terms of how to be able to reach their customers in terms of their e-commerce while still being essentially a brick and mortar company. And if you look at that list, there's several of them that are very popular in our community. Five Below, Floor and Decor, Ulta, Tractor Supply are all very, very common. So that even though they're not a direct competitor to those, they're very similar to those companies in terms of how they're growing their retail stuff in a internet age. Let's do our next slide. Here are the competitors. Again, you never can find really good ones with them, but I sort of like to look at this to see sort of how it fits in. Boot Barn, the square footage is significantly larger than some of the others. The ones that have the gold background, there's who I think their competitors are. And some of their competitors, they actually send their stuff out to other people as well. Like Johnson & Murphy doesn't have Johnson & Murphy stores. They just basically send it out to other people to franchise on it. But I sort of like to do this to get a feeling for where they are. So they're much larger store size than everyone except for Skechers, sort of their big outlet stores. So it's really kind of bigger than that. So there's really a lot more to it than just sort of being a small store like, say, a Five Below is. Next slide. Here's the SSG. Just like we talked about George Nicholson, he liked to be able to put a marking on the SSG when the new management came on board. So I marked where this CEO came in, and that was before the IPO. I took out the really bump up in sales in 2021. I think a 10, 11, 12% number would be really easy for them to hit and I think I'm being cautious with some of my numbers. I could have been a lot more bullish on these things, but I just felt because I was just a little concerned that these numbers would get too good to be true with that. So I'm going to sort of keep it there, and I think those are very sustainable numbers for them. Let's go on. Evaluating management. Not too often you can see a retail company that has 3 greens down there in the bottom. Every one of them is great. And here's the thing that's really amazing about them. If you look at that return on equity, it goes in 2020 from 16 to 34. And on top of it, it ends up, its debt goes from 61 in 2015 to 38. How many retail companies can you think of that ended up paring down their debt during this pandemic and increase their pre-tax profit? Seems pretty strong to me. Let's go on to our next one. There again, return on equity. I think, Rocky Brands and Genesco, they're sort of bouncing around between having equity or not. It looks like it's really between Buckle and Boot. Pretty straightforward. Let's go to our next one. This is where it really is. Look at what Buckle did. They had no debt leading up to the pandemic. They took on a whole bunch of debt, and now they have debt that's almost as high as Boot, and Boot's been coming down.
Kevin?
Yeah.
Are we sure that this debt in 2019 going forward is comparable to the debt in 2018?
Yeah, I think so.
I'm just going to throw in something for you to think about. The accounting rules on debt, long-term debt, changed in 2019, and they changed so that restaurants, retailers like Buckle and Boot had to begin to add their uncapitalized leases in here as debt. And I think for Buckle, for example, what you're seeing are leases rather than the debt that we used to see. I think the same thing is happening with Boot Barn, and that's why I think Boot Barn is especially attractive when the debt actually is less in 2021 than it is in 2018 before the requirement of adding those leases to the long-term debt was required. So I think the debt's a really good feature, but I think we should be fair enough to these other companies to know that these jump up in debt. And if you look from 2018 to 2019 in every one in the columns, both columns for all those companies, you'll see an increase in debt going on because of the stores that they have to account for their leases in.
I will take a look at that to take a look. Thank you.
Yeah.
All right. Section 3, I think these are pretty straightforward. You know, it's selling at a really low price in terms of its PE ratio. It's right where the lows are, which is a great time to jump in if you think it's a good company. So yeah, these are pretty straightforward. Let's go to our next one. Here's where I come up with our high and low prices. I'm setting it at a high of 18, and that gets me to a price of 164. And I'm getting a low PE at 7, which I think is pretty reasonable on the downside. That's about a third off of where their current price is. And sort of with retail companies, I feel comfortable because of the cyclical nature of things to sort of go down a little bit on that. And so that's the reason I dropped my low PE to the point where I could get a number that was somewhere around a third less than where the current price is. Because otherwise I'd get this with an unbelievable upside downside ratio. Really too good to be true. Next slide. I use this as a test. I think those are pretty reasonable projected relative value and PEG ratios, not too good to be true. They're maybe a little bit optimistic, but not too bad. But I think you're going to see that with a lot of companies right now. And let's finish up with our last one. Comparing it to the MyPar, again, the MyPar is 28.2, which is obviously too good to be true. I sort of move things down a little bit just to be able to keep it there. And I think the range on this one is somewhere between 12.5 and 21 between the projected average return and the high return. It doesn't pay a dividend, so you're going to have to get it by both PE expansion and by earnings growth.
Cool.
That's I think we're pretty. Here are the cautions. It's not a core stock. If you look at BI, the financial health is a C, which is kind of a caution. It doesn't have much coverage. Retail stores can be really, really fickle, so you got to be careful on that. And with them being a store-centric operation in the internet age, that's still, I'm not, I still have to see more of it. But I have seen it, and I own this company personally. And of course, since as soon as I bought it, it went down like 10%, but that's what you're supposed to do.
Yeah.
Anyway, that's it. So this is what we do in our digging into the BI. We sit there and sort of take the T. Rowe Price life cycle that's in the handbook as well, and sort of say where you think it's going to fit in there. I think it still has some explosive growth, but I think it's sort of right in the middle. I don't think it's mature growth. I think they have a plan, as they say, to grow their stores that can go up. I think it was in the 800, 900 range. I'm trying to blank on it right now. So I think there's a lot of growth. So that's it. There's my conclusion. I won't read it back to you, but take a look at it, and you can get the slides from Mark.
All right. Thanks, Kevin. All right, Ken, go ahead and take us away with an update on Western Alliance.
Well, this might look real familiar because I presented Western Alliance last month as well. So let's go through the slides real quickly. Western Alliance is a regional bank. If you're looking for geography when the bank began, look in extreme southern Nevada, eastern California, northern Arizona. If you can picture that geography, that's the beginnings of the bank. The bank has since expanded nationwide, and they have offices, single offices in various places. They like to refer to themselves as a branch light operation. So they don't open a lot of branches, but they do open a lot of different regional offices. You might want to go to their investors presentation and take a look. I've turned on assets on this picture because assets tell me the strength of the growth in a bank. And when I see those assets, that's characterized by that aqua line right there. When I see those assets growing at about the same rate as I see traditional sales growing, or for that matter, EPS growing, I get a warm, fuzzy feeling. This up, straight, and parallel extends to assets when you're thinking about a particular bank. I also turned on the Morningstar analyst estimates going forward for the next couple of years. We get some estimates for 2 years on sales at about 30%, and a long-term sales growth estimate along with some estimates for 2023 and 2024. I've pared that 2-year 30% growth down to a 5-year growth rate of about 20%. And I think that I could be reasonably happy with this SSG if 15% earnings growth comes from that 20% historical sales growth. Notice that in the last 10 years, a growth of about 20% gave me earnings growth of about 26%. So I'm cutting that quite a ways back and asking myself, what does the SSG then look like? Next slide, Mark. Western Alliance is really a family of bank brands, and they're listing some of those bank brands on this slide from their latest investor relations. They also have a slide that tells you all of the awards they've won in this last year, 2022. And again, they're on America's Best Bank list from Forbes, and they've been on that list year after year after year. I went back 4 years and found their name, and I didn't go back any further than that. But obviously, this bank is well thought of by their peer groups. Next slide. You can see how in the different quarters leading up to the most recent quarter in quarter 3, 2022, you can see how the different ways that the growth has come, and you can see that they were depending a lot on commercial and industrial loans, and while they're growing still, they represent a much smaller portion now of the total package that the company is investing their money. I think those descriptions are pretty accurate. CRE is commercial real estate, and residential and consumer loans are the gray area at the very top, making up a little bit less than a third of their business. Next slide. Their business has transformed itself significantly from 2010 to the current quarter. You can see by the circle, they've added a lot of other categories to their loan portfolio, and the amount excuse me, folks.
Bless you.
And the amount of their loan portfolio has significantly increased in the last 12 years. You can see that in the beginnings of this bank in 2010, over 40% of their loans were based in Nevada. And those Nevada-based loans now have dropped to about 5% of the portfolio, and other loans have moved now to be at least half, a little bit more than half of the portfolio. Again, a really good, easily understood investor presentation for this company. Take advantage of it if you're interested in buying this company. Next slide. Here's where our tool, SSG Plus, really helps as far as I'm concerned. We've learned through experience and through listening to some of the bank examiners in our community that if a bank can put a return on average assets, that's ROAA, return on average assets, if it puts up a number of about 0.85, that makes it an average bank. Very average. A good number is 1.25. And a superb number is 1.5. And what makes a bank itself just go to the top of the heap and stay there is when it can hit that 1.5 year after year after year. When it can do it for 4 or 5 or 6 years in a row, then you know you've found a real winner. There can be some variation going on, obviously, but we go back to 2015 and we're still above that 1.5 return on average assets. This is a superb bank. Next slide. I used 11.6 going forward for the high average for the next 5 years. Notice that was the high average PE for the last 5 years. In other words, I'm anticipating that PE values have been reevaluated in this bear market, and I'm not going to shoot for the moon. I think 11.6 is a nice average number for the high going forward. If it does better, that only means that the returns are better. I used 4, and that's actually the lowest low that it hit during the last 5 years, and I used it as the average for the 5 years moving forward. This time at Roundtable last month, the stock closed at 65.48. Last night it was closing at 66.42, so moving in the right direction month to month. I still think it's a wonderful buy, however. Next slide. I'm getting a par of 19.1% with these choices on this SSG. That compares to Manifest Investing, which calculates the par to be 19.0%. Those two numbers are close enough for the work that I'm doing. I'm getting validation from Manifest, not using those numbers to start with and then coming up with a par that's in the same ballpark at the end for a conclusion validates the thinking that I've been doing for this particular stock. Notice that it might end up as high as 28%. So I'm looking at a range in there of 19 to 28% for returns. Certainly something really nice for something with as simple a business model as this bank has. Next slide. I think there's one more. Nope, we're done. So I would just, I'm going to add another $1,000 to Western Alliance. And if you think we could use some bank money into the portfolio, I'm urging you to put another $1,000 in Western Alliance as well when we vote. Thank you.
Yeah, thank you, Ken. And we did point out that Western Alliance was the top performing best small company from 2 years ago, and it really bolstered the portfolio 2 years ago when we had our 7th consecutive year of beating the market. So we tip a Thanksgiving cup in the direction of Western Alliance, even to this day. All right, I'm going to take us in a slightly different direction. We talked a little bit about this at this afternoon's bull sessions, but and went through a number of screens. If you want to look up the bull session notes on the Manifest Investing webpage, those are all there. I didn't pick any of the stocks. We came up with a bunch of decent ideas for study. Instead, I want to focus in on this concept of a good company is going to face challenges over its lifetime as a corporation. And it's actually a theme that has been presented by Hugh McManus when one of his vetted companies is dealt a challenge. We've also heard it from Cy Lynch in terms of thinking whether the challenge facing a company is temporary or terminal. Those are very different things, and they can present an opportunity, and they can also be a trap. And in the case of Apple, they are going through a moment, especially with their sourcing in China being in some state of jeopardy, the political pressures that are over there, and along with some other things that are kind of kicking up and making some noise, including this guy. Basically, Apple has threatened to remove Twitter from their store. Mr. Musk obviously does not care for that line of thinking. And his response to that would be to basically try to put iPhone out of business or declare a Twitter war, as it's shown right here. So again, I'm kind of hoping that Apple does not agitate him, because who knows what they're capable of. As I've pointed out a number of times during bull sessions, this guy lands rockets on barges. So I don't think they necessarily want to annoy him. So just something to think about. Here's a look at Apple over the last several months. The stock price has pretty much tracked with the NASDAQ 100. That's the green shaded area in the background, the NASDAQ 100. And it actually has done a little bit better than the NASDAQ 100. But with the news, the stuff going on in China, the rioting in China has actually shut down some of the manufacturing centers. Now, Ken pointed out this afternoon that the Chinese government appears to be relaxing some of their zero COVID situations. That might bring some relief. I do find it kind of interesting that the institutional investors are apparently not panicking. There's not a big run up in volume here. Certainly not showing any signs of a dramatic increase in trading activity. If that were to happen, and if they were to declare war on Twitter, we probably would see something there. The one thing that I'm going to point out through the course of these slides is that I would not be the least bit surprised to see this stock price drop down to $120, perhaps even $100 or $90 a share. So I'm basically presenting this as an opportunity to accumulate during this period of challenge. During this afternoon session, bull session, we talked about other examples of a situation like this. Nokia, back in the first part of the century, when they were faced with a threat to their cell phone business, they didn't do very well. In fact, they basically disappeared from the planet. They are only now reemerging, and actually might be worth watching to see actually what they do with their cell phones around the world. They are still a $25 billion business. Then we talked about a couple of other case studies. Wells Fargo back in 1990. Basically this was on the heels of the bank and savings and loans fiascos that happened back in that time frame. I find it kind of fascinating that you can barely see the blip on the radar screen, but back in that time frame, Warren Buffett looked at the company and said, I still see a good core bank operating in the background there, and invested. In fact, he bought 22% of Wells Fargo back in the first half of 1991, and only recently sold it off here in the last year or so. And Coca-Cola is also fairly infamous for their 1980s experiment with New Coke. And then they also experimented for nearly a decade as owners of Columbia Pictures. So these type of things can be dealt with. And when you persist with an excellent, well-managed company, it can be quite rewarding. In the case of Apple, they actually had their own moment in time when they came out with the Lisa computer. Some of you probably remember the Lisa computer. The equivalent cost of a Lisa computer today would be $24,000 or $25,000, and it had a 5 meg hard drive. on it. So think about that and how much has changed over the years. And obviously they came out of that okay, went on to do their Apple II and Apple III computers, and then of course the cell phones hit, and it has been quite rewarding for investors in Apple. And you can see $1,000 invested in Apple is worth over $1 million today if you had done it on the day of the somewhat disastrous Lisa project announcement. So here's a current day look at Apple and why I'm interested in it. It does not have a real sexy return, certainly not the 20 or 20% type returns that you've heard described so far tonight, but I do think we might be looking at a period of time where they can come under some pressure from some of this stuff that's going on. I would point out that the quality is great. It's basically flatlining up near 100, and we will be filling this stuff in here soon. But the projected annual return, the return forecast at Apple right now is as high as it's been for, again, you're looking at a period of about 5 or 6 years. So that's a pretty good deal. That the return forecast is not incredibly sexy, but it is at a multi-year high. Here's a look at the operating characteristics for the company. And again, since the advent of the iPhone, it's been pretty steady. You can see a little bit of pressure with COVID here, a little bit of price disruption and a little bit of earnings disruption here with COVID, but nothing to write home about. And you can see that the expectations may be tapering off and slowing down a little bit, but still it's approaching double digits, 9, maybe 10%, maybe a little bit less than that. But fairly reliable picture, especially for a company that is in quite a competitive environment. And the earnings actually look pretty good there. Here's a look at the profitability of the company. Again, the operating margin's fairly steady. You see a little bit of discomfort here, and that actually bubbles all the way through to the PEs down here. That's why these are disrupted. But the bottom line net margins are pretty solid, right in that 20% range. Like it a lot. And the PE ratio has matured and probably belongs somewhere in the mid to upper teens. So here's a quick look at all of those characteristics on one page. You see that the return forecast, according to the projected return on value, is somewhere in the 9% range, looking at 11 to 12% on the projected annual return. So those compare pretty favorably. Maybe a little bit robust on the PE here. But again, a double-digit return, looking at the possibility of a little bit of a sag in price. Could wait for that, but who knows if that's ever going to happen. And a lot of really nice characteristics here. So I'm going to go ahead and begin an accumulation potential for Apple. One of the things that I do find fairly interesting is that the Morningstar price to fair value is above 100%. But the rhinos, the institutional investors, have a very different outlook. They think that the company is actually fairly dramatically undervalued under the current conditions. So we'll see who's right. So we're going to go ahead and start a position in Apple and see where it takes us. All right. And with that, we can turn it over to Cy and a selection of First Foundation.
All right. Thank you, Mark. And I'll move through this reasonably quickly. First Foundation has been featured either 4 or 5 times. Ken has brought it about 1.5 years ago and several times since, and the audience accumulated it once. As Ken mentioned when he was talking about Western Alliance, I also included the total assets line in this chart, and you see, again, generally up straight and parallel. The biggest difference, well, not the biggest difference, there's a good number of differences, although like Western Alliance, First Foundation has started in the West and has gradually moved east in its expansions, largely through acquisition, but it is a much, much smaller bank. You can see quarterly sales of just 86 million last quarter. So they are a small bank. Next slide. I wanted to explain, as I usually do, how I got the company. I first went to the public dashboard ranked the roundtable portfolio by par and skimmed down. I'm familiar with installed building products, although I did not bring it and don't follow it particularly closely. The MKSI, we've already mentioned earlier today. I see that up on the leaderboard, and so I considered it. But what I wanted to do before settling on a stock, I said, let's do a screen to see what out there meets similar criteria, maybe better. And I'll go ahead and mention that Notice First Foundation is, as I mentioned, an existing holding, and it's here, but I was not particularly familiar with it other than just Ken's presentations previously. Next slide. Okay. Go to the next slide, Martin. Did we skip one or did I? Okay, back up.
Okay.
Back up one more just to make sure you didn't hit it twice. Okay, I must have either left out a slide or deleted it. The next slide was my screening results, which was plugging in the MKSI potential return of 22%, and it's I think I used a 90 quality and an 80 for excellent financial return, and I got a listing of about 15 companies, among the highest being First Foundation. So I said, let's investigate First Foundation a little bit further. So this then is the next slide that we get to, which is a quick industry study ranking by par. You see First Foundation is the highest returning regional bank. You've heard about Western Alliance from Ken, and Signature Bank is also in the portfolio for Roundtable. I then ranked by growth, and First Foundation is the fastest growing. So I was attracted to this to give us a smaller bank potential and also significant potential growth going forward. But notice that yellow par, 31.3. Is that too good to be true? We'll revisit that at the end in my projections, but the rest of my analysis of the company and investigation of the company itself is seeking to not to figure out why is that par so high, because right now banks tend to be out of favor because of potential recession, because of rising interest rates, which tends to, at least when interest rates shift from going down to going up, or from being steady to going up, adversely impacts banks in the market generally. I wanted to make sure that this was a solid, safe pick, regardless of what your projections are. Next slide. So here's what the company is. It focuses on two major segments. They don't do investment bankings like money sitter banks. They do have a wealth management side. In fact, it started as a wealth management company in Orange County, California, and then added a bank and grew. And you can see here that they focus on investment management for individuals as well as retirement plans and institutions. They make loans both to individuals and corporate entities for real estate loans, and they also have business banking and consumer banking as well. Next slide. I'm not going to read this or even really hit it. This is just from the company's presentation that's on their website. They give investor presentations at least quarterly, so I encourage you to go to the company website, find the investor relations link, and take a look at the reports. But again, this just gives you some of their take on their business and what they do. Notice that 49% of their loans are in multifamily housing. That's the bulk of their loans. Then next are commercial loans that are not real estate related. and then single family homes as well. Next slide. They again started in the in the West, in California, have moved to Texas, and now just made an acquisition to move into Florida. They also have some Nevada. Don't believe there's any Arizona. I can't quite see on that chart there. No, they do not have an Arizona presence. They do have a Hawaii presence, as you can see. Again, relatively branch light to an extent, but their loans tend to be concentrated where their branch offices are. The majority of the loans currently are in California, as you can see here. And they seek to expand in markets that have positive demographic trends. In other words, growing markets population-wise and business-wise. Next slide. Now, here is where I'm concentrating on safety. Is this bank able to withstand the challenges that banks are facing right now, both from a business environment, potential recession, and how it might impact their customers and those to whom they have lent money, as well as just the interest rate environment. You could see here for both the multifamily and single family real estate loans, average loan to value right around 50%. That's a very low loan to value ratio, means that the security on their loans is significant. They could certainly withstand some decline in real estate value should that occur, as well as they should be well secured. But notice those delinquencies. 0 delinquency rate in their multifamily, which is their largest loan component, and very low for single family. Next slide. Again, just another way of looking at loan quality. The first bar is First Financials, non-performing asset by year or charge-offs by year. And then the gold line is their peer comparison. So you see that they all the way across are well below the peer averages on both non-performing loans and assets, as well as charge-offs against their loans. Next slide. Something that I like to look at in banks, particularly in a changing interest rate environment, unfortunately, for most of First Financial's publicly traded history, which, by the way, they went public in 2014, so they've only been public 8 years, and we have 8 years of history, although they have been around for over 20 years in their various iterations as they have grown. The net interest margin is the difference between the interest that they take in on loans and the interest that they pay out on interest-bearing accounts or loans that they take out. And you could see that even though the last 4 quarters have been a rising interest rate environment, their net interest margin has stayed quite stable. So they are reacting well so far to the changing interest environment, at least when it comes to matching loans to deposit rates. Next slide. Ken mentioned return on average assets. Here is First Financial's return on assets. You see that they've been steadily increasing over the last 5 years, and really going back even further than that. They again, by the way, if you go to FDIC.gov, there is an FDIC quarterly report that gives you aggregate statistics for all banks that are insured by the FDIC, and the current return on average assets in the aggregate, that's not an average or a median, that is all insured bank assets and all returns on assets, is running through the second quarter of 2022, which is the latest available, is running right at 1%, which was down from about 1.2% in the first quarter. And you see that First Financial was well above that last year. Their current return on net average assets through the third quarter is right at 1%, which I expect again is above the aggregate, since it's at the same as the aggregate was at the end of the second quarter. And I expect that it will continue a downward trend on the aggregate. Next slide. Again, just another shot. The company gives you the return on average assets. There is that dip in return on net assets that happened in the third quarter. When I said it was about 1%, that was for the quarter itself, just 3 months. This shows the trailing 12 year to date through the third quarter. And it's a little above 1%, as you can see. Again, above that, both the average that, or not the average, the aggregate that FDIC reports, as well as the kind of 1% average, that rule of thumb that we mentioned as well. There are some other profitability figures here that I won't mention. I just want to explain that drop in return on assets. And if you look at the front side of the SSG, you'll see a drop in both pre-tax profit line and earnings per share in the third quarter. There is something called, and I have to admit, I've been studying banks for many years and looking pretty closely at them, but I did not know that there is a imputed interest charge that banks recognize on commercial loans, that they pay out on loans even that are non-interest bearing. They use it to offset fee income or fees that are paid by commercial borrowers. And that went up significantly because it's often tied to the treasury rates, which treasury rates have gone up in the third quarter, between the second and third quarter, and that cut significantly into the non-interest. It's non-interest, even though it's called a account carrying charge, but it is an imputed interest rate, but it is reported in the non-interest expense item, and that's what accounts for that drop in average assets. As you saw, the interest income, on the other hand, has held up very well, both through net interest income margin that I showed you, as well as, I didn't put the charts here, but their loans and assets have gone up significantly in the last year. You can again see that on the front side of the SSG, at least assets. Next slide. And this is just this summary by the company of why you should invest in it. They have solid financial performance, a valuable business model, they have good leadership, and I've stressed in this presentation the credit quality. Next slide. So here's the key judgments and a bottom line. This is the manifest consensus Eagle. Again, a very high upside of 31.5%, maybe a little too good to be true, but notice that quality of 91% percentile, 91 percentile there, very high quality. Next slide. Again, this is the Chronicle looking at history relative to the market. It's the highest that First Financial's ever been, and it also, since Manifest has been tracking the stock, it's the highest potential return. Next slide. Could be a good buying opportunity. Again, because it was a very high yellow pick and banks are way out of favor, and especially a small bank, there's certainly potential risk. I said, let's look at what I'd call the worst case scenario SSG. I believe I did this for MKSI a few months ago as well, and said, if I really beat this stock up, what's it look like? I chose a 10% sales growth rate. And that's not arbitrary. It's, you notice the average for the 8 years of history is 23%. Where the 10% comes from was around 2019, 2020. There was about a year to 6 quarters, 4 to 6 quarters, where that was the company's growth rate, kind of in between acquisitions and so forth. It went into the pandemic slightly, but it really was pre-pandemic that it started, and then the post-pandemic growth picked way up again. But that is an actual growth number that the company had in the late teens, early 2020. So I said, let's assume that it falls back to that rate. I used average expenses, which actually pre-tax profit margin has gone up significantly. It's currently over 50%, but again, profit margins are being squeezed right now. So I said, let's let it fall back down to the average. I use current taxes, current shares. That may actually go up a little bit because, again, the company grows through acquisition and it issues shares. But that gave me $2.91, which is less than half the manifest consensus potential. Next slide. Again, if you're going to have falling sales and falling earnings, that's going to drive your PEs down. So I used a 12 high PE, which is actually below the average for the last 5 years. And I used an 8 for the average, actually used a low PE, which was a pandemic low PE of 4, which gave me the average of 8. And you see a good solid return using the average PE of 13.2. But then using the high PE, an even better return of 22%. And then you can still make a good argument that even the manifest consensus, while it's very yellow, is not out of the ordinary for a hard hit bank stock. So I'm saying let's add another 1,000 to the auto portfolio.
All right. Thanks, Si. All right, Ken, you can go ahead and release the poll. Give Western Alliance another chance.
You know, you just need to have more banks.
We actually don't have much banking in the portfolio itself, Kevin. We've been a little bit reluctant to put many banks into the portfolio itself. It's only been the last maybe couple of years that we've started even looking at them seriously.
No, I have to agree with you. Is what we were saying at the beginning of this is that, you know, if a company wants to expand, they're going to need banks. So banks will be the canary in the coal mine in terms of where we come out. You know, once we get out of whatever malaise we're in right now.
We'd love to have 85, 90% of you voting. We're up to 75% of you voting. It just takes a click of your mouse, or if you have a touch screen, maybe you just can touch it right on the screen and give ourselves a vote. It's up to 80%. I'm going to give us about 10 more seconds, and then I'm going to close the poll.
That's it, Kevin. We're bringing Portillo's.
And I'll do Edward Life Sciences right next to it. How's
There
that?
you go. That's that vertical integration thing.
We'll close the polls and we'll share the results. and I'm pleasantly surprised because I frankly thought that all of these would have run pretty closely. I was pretty impressed with the whole group tonight. So we do put another extra thousand into Western Alliance tonight. First Foundation and Boot Barn both get about a quarter of the votes, and maybe people are just fatigued with Apple, Mark. I don't know, you know.
Oh yeah, I get it. I mean, the only reason I brought it was to demonstrate how every time Hugh McManus says, "Oh, it got hit again today. Good, I get to buy more."
So I'm going to hide this poll. I am going to unmute Linda Bergwell. Linda, you'll have to unmute yourself if you want to ask us a question.
Yes, I
Go on.
noticed on one of the slides, it was presented for this FFWM, which was First Foundation. You had FFIN, which is First Financial, which is a different bank that I own. And I'm wondering why that FFIN was in there when it was FFWM. Is First Financial a part of this First Foundation?
No, they're not tied together at all. I'm trying to see where you don't remember the slide number, do you, Linda?
No, I don't.
FFIN was one of the lowest returning stocks.
It might have been way back when we were speaking about
It
return.
was actually when Cy was talking about the First Foundation. It was within that bunch.
Okay, well, I'll have Mark and Cy take a look at the slides, and if there is a typo,
Stop. Go back. Go back.
It's just
At
go
the very
back.
bottom, it says First Foundation, but at the top, it says First Foundation, First Financial.
Yep. Okay.
Oh,
That's just a typo on my part.
Okay, that was Cy
Okay.
just got the wrong word. That's all. So
The
he'll
top
fix,
just said First
he'll fix
Foundation.
those. No, these
Okay.
are all the
Should be.
slides are about First Foundation. Yeah.
Yep, they're all First Foundation.
Okay,
Okay.
thank you.
Thanks,
I had just had an emergency or semi-emergency visit to the dentist to have a temporary crown that had popped off put back on. So that maybe is my excuse.
Okay. I'm sticking to it, right?
That's right.
I will tell you, it's easy to do. When I was going through the regional banks, oh my goodness, there's a lot of similar ones. So you do have to be careful. Just wanted to remind everybody that we do archive all of these presentations, including the bull sessions and the roundtables. And in fact, the bull session this afternoon is already up and running, and we actually went through those case studies, if you're interested in that, for Wells Fargo, Coca-Cola, Nokia, etc., in much greater detail, showing a little bit more of the individual case studies. And I would also point out that our best small companies for 2023 are also available on
Mark,
the YouTube page.
we have Ross Meredith in our audience tonight, and he'd be glad to give us 4 or 5 minutes on his view of the banks in the industry right now.
Okay.
Would you be interested in us doing that?
Absolutely. I mean, when we can just
I
call
would
that
be
part of
very
the Q&A.
interested in us
Absolutely.
doing that. Give me just a chance then to find Ross on the list here. And Ross, if you'll get ready to unmute yourself if you need to. Let's see if.
Do you think I should pull up that list of regional banks from this afternoon, Ken?
Let's get him on first, okay?
Okay.
Ross, you're unmuted. I'm not hearing anything.
His microphone's on now.
Yeah, I know. I unmuted him, but I'm not hearing anything. Ross, can you say hello or something?
He may have stepped away after.
Okay, well, that would have been quite an addition to what we've been talking about this evening. Ross, can you hear me at all? We cannot hear you. Maybe you're muted on your microphone. Well, I guess that's not going to work, gentlemen. So, Mark, other than that, we've taken care of the questions for the most part. there's been a number of folks that would love for you to rework the portfolio for the entire roundtable. And I think we're explaining to people that it's a little bit more complicated than it seems to rework it and then keep storing it and pulling it back and everything. We're also getting an echo right now.
I think it was coming from Ross because I just muted him.
Okay.
Yeah, I was going to say that may be Ross since we unmuted him, but he's not there.
Okay.
So.
Yeah, he's muted again. Okay, so Mark, I don't have anything else to go. You can explain this slide here if you'd like to from the bull session this afternoon.
Well, this is just a quick, short shopping list of all the regional banks, but sorted by their return on assets on the far right. And one of the reasons I thought it was worth getting out would be if Ross had something to say about some of these characteristics that are on display here. The one thing that we did point out this afternoon, Western Alliance, which Ken just picked, had the highest return forecast and among the highest quality. And the other thing that we speculated this afternoon is that the financial strength index, the higher ones like First Financial, which we were just talking about, First Financial, Service First, and a few others, probably have a more established track record of exceptional return on assets also. So,
okay, and we did make the point real well at the bull session that when these numbers appear as high as these particular numbers are for return on average assets, we'd love to see that happen for 3 or 4 or 5 years in a row. It really gives you a good strong bank when you see consistency in that. I'm going to try once more to unmute Ross. Ross, you're unmuted. Can you hear me?
I can hear you. Can you hear me?
Well, we can hear you now. So why don't you go ahead, Ross, and enlighten us a little bit about banks.
Okay, in a real general sense, the regime has changed over the last 10 years. Extremely low interest rates have made sources of capital for businesses plentiful. The Fed has provided lots of liquidity, so the need to go to a bank has been low. However, now that the Fed has no longer done that, the need for capital is more imperative. A lot of companies that used to fund themselves with very low cost bonds are now going to banks to do so. So the demand for loans is rising and interest rates are rising. Those two things are like tailwinds banks haven't seen for the last 20 years. I think things are going to improve earnings-wise in the banking industry in general for some time to come.
So, Ross, am I hearing you say you approve of us looking at banks and perhaps choosing a couple for the portfolio?
Absolutely. I think it's long overdue, and frankly, my personal portfolio is heavily weighted in banks. Not just because that's the only thing I understand, but because I think this is a good time to own them.
Mm-hmm.
Okay, well, we appreciate your input very much, Ross. Thank you so much. Mark, go on, Si.
I was just going to say before Ross came on, but it fits well with what Ross just said. If you are not familiar with investing in banks and you hear Ken and me and others talking about return on assets, understand that for a bank, assets, this is generally speaking, there are other types of assets for banks to include their fixed assets, but the bulk of assets for banks, what banks make money on are loans, which most of us, when we think of loans, we think of debt. And debt for banks, many banks are very highly leveraged and have a lot of debt. Debt for banks are deposits. There are other debts as well. They do take out loans both from the Fed and from other banks and so forth. But bank debt is primarily deposits, which we frequently think of as assets. My checking account, my deposit account is an asset, but to the bank, it's a debt because they owe me that money. That is my money. So just understand that when you first start looking at banks, sometimes you need to flip-flop what you frequently think of as debt and assets.
Thanks, Si. We appreciate that.
If Ross,
Mark, I've caught the questions all up. I don't see anything else coming into the queue right now. So maybe it's time to wave our hats at folks and say good night, everyone. Thank you for coming and listening to us tonight. A big special thanks to Kevin. Kevin, we definitely will have you back again if you'll take the invitation. And as always, Si, thanks to you when you get a chance to help us out. And Mark, you know how much the chapter thinks about what you do for us here in Mid-Michigan and for what you do in the folks in the whole community. So with no further ado, I'm going to wish everybody I hope you had a happy Thanksgiving, and the next time we talk to you, Christmas will be gone. So Merry Christmas, everybody.
absolutely. You're
Good
most
night.
welcome.
Thanks for having me.
Thanks, everybody, and thank you, Ross, too.
Good night, folks.
Good night.